Okay, we are recording. So, welcome to the Bybee Education on Monday, the 28th of November. The webinar is now recording. As I was going through and thinking about what to go over with you, it really came down to goals. So, out of curiosity, what goals do you guys have? Type in a goal or two. What are some goals that you guys have in regards to, obviously, the stock market? Give me a goal. What are you guys thinking of? Any goals? Or have you even thought about that? Okay, we've got a couple coming in here. um, Able to make a consistent income and not losses. Alrighty. Keith says find money to invest, and Jeff says not to lose my dough. Make some money for retirement. There you go. Emily, since you're the first one, define consistent income. How do you define consistent income? Success. Okay. Is success making money at the end of the year? Is it making money in the first quarter? What's your definition of success there? Quarterly. There you go. And I guess that's obviously, since we've had this discussion, each quarter Emily would like to see her accounts up, to be able to pull money from them to create some income or some money to have to obviously use, right? Makes perfect sense. Key, find money to invest. That makes sense. Not to lose my dough. Jeff, are you still with us? Define not losing dough. In fact, Jeff, it's kind of funny because yours might be one of the more relevant ones here. I'm going to ask Emily and Keeve, when do you lose your dough? What I've already accrued in a 401k, don't want to lose it all. There you go. That makes sense. When do you lose money in the stock market? This is a key point to understand. When do you lose money in the stock market? Emily says when you don't watch it and keep track of what's going on. Okay. That is partially true. I'm looking for something a little bit different. There you go. When you take real losses, when you say, you know what? I can't take it anymore. When you say you can't take it anymore, that's when you lose your money. When you get out and you just say, I'm done. When you can't take it anymore. So I'm going to ask Keeve. Keeve, you were killing it at the start of the year, the beginning of the year. I mean, you made me look bad. You were doing so well. And I guess my question to you, Keeve, why didn't you stop then when you were up 50%? When in recorded history, there's never been a 50% up year in the stock market. Why did you not quit, turn to cash everything then and stop? I'm going to start to ask some of the tough questions today. There you go. Good answer. You figured since you had some profits, you had some of the house's money, you could take a little more risk and try to make it really big. Good answer. It makes perfect sense. And if I went around, I'm sure I could ask Emily, Emily, you had the opportunity to put more money in the stock market. Why didn't you? And Jeff, I'm going to say, Jeff, are you still holding on to Disney? It's these type of questions that are going to be the decision makers for you down the road. Down the road, and this is where you run into those things. Man, what do I do? I'm pretty sure I showed you. Where is... Let me get it up for you. Kind of nice on a day like today. I was up about $3,000 earlier. Where are we at? Come on, paper trading. This was the account we started with you at the beginning of the year. It's empty. Nope. We're up 28,000. We've got a 28% return year to date. And for the most part, I'll be honest with you, I mean it was pretty boring. We have two stocks that are down significantly. We had one that's up a little, and we had one that was up a lot. And you guys watched me work on through a pretty, in all honesty, a pretty small, short-running year. I mean, it was nothing spectacular. See if I can get our positions up. In fact, what you saw was me take about 6 weeks off during summer. Went to scout camp and went to different things. All right, we'll stop the plug-in. You guys watched me, for all intents and purposes, take 6 weeks off and just kind of be uncertain about this year's stock market. And it's funny because the money under $250,000, I look like a genius. We're in that 28 to 35% range. In the 250,000 to 750,000, I look okay. I'm matching the market average, but in matching the market average, we've picked up extra shares. And my big money over $750,000, I look like an idiot. I literally look like a chump because I haven't, I've overprotected. Big money usually likes to protect their money. It's more important to them to not lose it. And, you know, with all intents and purposes, I've way overprotected this year for my big money. Now, I can justify that as well. They wanted the protection. They wanted to sleep at night. It's kind of funny, though. No one wants a bunch of protection when the stock market's going up, which means you have to be able to bounce around and be active in your positions. Disney and Ford are down significant amounts of money this year. Visa really hasn't moved, and we had one stock that moves pretty big, which is Netflix. So if I was to look at this account, I would see, hey, my expectation is next year I would most likely see Disney and Ford knock it out of the park. Well, Kevin, aren't you just hoping for that? Maybe. Maybe I'm just hoping for it. But Disney has really low estimates that it didn't make this year, which means the estimates for earnings will be even lower next year. Ford went from 15 down to 12. So it also has pretty low estimates that it has to beat next year. Netflix has some pretty high estimates. Netflix has to do really, really well for it to really make any money, for that matter. It has to beat ridiculous comps and earnings. It'll be really hard for Netflix next year to go up. And Visa is wholly dependent upon rising interest rates. Visa's just kind of gone more sideways than up this year. And the only reason why is it just hasn't been able to take off. Visa just hasn't been able to move because we haven't known what the interest rates were going to be for the Fed. If I was in Netflix today, which I am, and I just haven't done it on this account, I need to add a December $115 short call. So I'd be looking to add a December $115 short call on Netflix so I can go ahead and be prepared to be called out of it and to make a profit. All right, let's get over to our goals. And I'm sure you've seen this quite a bit in the past, so let me just go over it really quickly. As a coach or as a instructor, so I should probably change that to instructor. I've had a lot of people talk to me this past couple weeks, and I've heard two questions over and over again. I've heard everyone ask me, so what are we going to do in 2017? And then I've had people literally looking for how much I'm going to make. Kevin, what are your goals? How are you going to make money in 2008? Came up over and over again. So I'm going to ask you guys that question. What's going to happen in 2017? I'm going to ask you three here. What's going to happen in 2017 in our stock market? What do you guys think? What's going to happen 2017 in our stock market? Keith said it's going to get a 50% return. Keith, I like your optimism. Emily, rates will go up and stocks will take a drop. Nobody knows. It's funny. So we have Emily that's practical. Hey, rates are going to go up, stocks will drop. We have Jeff, who is the realist. Kevin, no one knows. Stupid question. And then we have the dreamer in Kiev that says, hey, it's going to go up 50%. Because for crying out loud, the Trump rally is going to roll. It's going to keep rolling like there's no tomorrow. So I think we've hit all edges of the spectrum. And the reality is, as I talk to people, I probably start off with something around Emily. Well, chances are rates are going to go up, which will hinder growth for big S&P 500 companies, and it'll really hinder growth for the small companies, for the Russell 2000s. It'll be a growth hindrance for those positions. And then I'll come and I'll say something along the lines of, well, don't forget nobody knows. And then I'll finish up the conversation along the lines of, well, the good news is we've had some of what we've traded not really take off. So as I have these questions that come to me, I mean, it's kind of funny because my answer is going to be right along what you guys said. Rates go up, significant government structural change, which makes stocks go down. Why? Less, I shouldn't call it free money, but it is less free or cheap money for businesses to use, and uncertainty in what Trump will do to the current trading agreements already in place. And again, simply, you then hear me say, but nobody knows, and a lot of what we invest in, of course, none of that's typing, is it? But nobody knows, and what we invest in has a great, I usually don't want to say opportunity, but has a great probability to come back and move higher. So goals. It's interesting because I believe most people lose money in the stock market, and their primary goal is to make everything back that they lost in 2015 or 16. And it's that ego that loses people money. There is no proof that things bounce back. But the key is to kind of keep your head in place, to keep your head in the game. I guess that's the best answer. I don't really say it there, but it comes down to collar trading. I made a comment in here, you don't go broke taking profits. And Kiev, if we were trading in real life and we had real money clients, real clients with money in the stock market, Kiev, I would have pushed and pushed and pushed to have you take profits. Anytime you get a 50% return, you'd be set. Sometimes trades just don't bounce back. And because of that, you have to set goals. And so the goals, I've come up with little SMART goals. That S in SMART stands for simple, specific, and scheduled. I like that acronym, keep it simple, stupid. Set primary exits for your trade. Decide on specific amounts that you're going to invest in certain positions. And remember, you can check your goals on a daily basis. But it doesn't mean you have to do something in the stock market with it. It takes time. If there's one thing I can impress upon you, there is no magic bullet. There is no magic algorithm, computer program, person. There's nothing that someone does over and over and over and over again that always makes money in the stock market. It just doesn't work that way. So what people do, or what they have to do, is to learn to take those profits as they come and when they come, and to literally be able to look longer term when things don't work the way you want it to. Now, I am going to hear someone that's going to tell me, but Kevin, my 401k is down. And Jeff, I'll say, yes, it's down. But are you worried that Disney is going to go out of business? Is that a worry that Disney will go out of business? And no, there you go. Shouldn't be. So we're kind of held at the market's to realize Disney's a great company, not going to go out of business. Mona just made $81.8 million over the Thanksgiving weekend. It's definitely not going out of business. But when will it come back in favor with the market? We don't know. The M in SMART stands for measurable. We're looking for pinpoint goals. We might decide that we want an average return of a 7% in 1 year in the market. When we hit that goal, literally, we don't quit, we don't stop trying, but we set a range goal. We set a goal that's realistic, that gives us the ability to fall somewhere in that range. People get frustrated with me as I go through financial planning with them. They want a specific number. And I usually tell people, hey, my first goal is to beat the S&P average of 7.75%. My next goal is to double that to 15. And if we get to a 20% return, my goal is nothing more than that year to make sure you have at least a 20% return in the stock market. And people look at me like I'm crazy. Well, why would you go for a 40 or 50% return? And most people don't like my answer. Well, because that's never happened in market history. So if you want me to swing for the fences with your money, I can do that. More importantly, why not be a little more realistic? Why not be a little more realistic in what you have and what it's going to do, so that we don't just blow money for no reason? Attainable. The A stands for attainable and SMART. Make a plan how you plan to attain those goals. This is a step-by-step process. Your goal might be, hey, I want to become a better trader. Or, I'm going to use Keith's example, I want to find some money. That's a great pinnacle goal. But in that pinnacle, you got to work down your triangle, right? And you've got to set smaller goals to get there. Anyone want to take a guess? What's the number one goal that people talk about in the stock market? What do you think the number one goal is that I hear people, or in general, when people talk about the stock market? What do you think it is? Keep up with the S&P. Didn't hear the question. Sure is time. Number one goal that people talk about in the stock market, I want to be a millionaire. That's their goal. And apparently, if you just throw money in the stock market, you automatically become a millionaire. Which is kind of funny because nowadays, I'm not sure you could even retire off $1 million and have enough money to make it. So if you're going to be a millionaire, you need to literally work backwards. Walk yourself backwards. Okay, if I'm going to have $1 million, how do I get there? Well, first I need to get, 900,000 or 800,000, and you literally walk yourself backwards on the small little details that are going to get you there. For smaller accounts, you usually have to start off with all option trades. And eventually, you're going to get to a point where you've got a portfolio that's more important to protect it. And in that case, you're then going to move money from option trades into collar trades. And the process to make your money obviously just trickles down from there. The R in SMART stands for realistic or relevant. I tell you, I always wanted to make a 50% return or more. Some years like the past year, I wasn't close to getting that goal. That's what happens in real life. So the biggest question you're going to fight on realistic or relevant to the stock market, are you going to quit because you didn't hit a goal? Or are you going to do something else so that you can attain that goal? And I'm now plugged in. And so those are your questions you're going to ask yourself. A goal is literally just that. It's just a goal. It's something you want to achieve. I'm not sure in the stock market that you ever get converted to making riches. What do I mean when I say that? Well, in the church, obviously, when you're in the church, you make goals, and sometimes your goals are, hey, I'm going to say my prayers, I'm going to read my scriptures, I'm going to do better on paying tithing at the beginning of the month instead of the end of the month if I have anything left. Or, for some people, they're already converted. They don't need to set a goal to say their prayers because they internalize it. They do it every day no matter what. Some people are converted on tithing. They just write the check out at the beginning of each month. They don't think twice about it. So where I'm going at with this is understand a goal is just a goal. And there's some years that we don't hit our goals. But as long as you're still progressing, as long as you're still learning, you're gaining experience, you're moving forward, you're not making the same mistakes again, it's okay to not reach your goals. More importantly, don't quit. If you quit, there's no way you're ever going to reach anything. And then the T for time is obviously the time period. the time period that you want to accomplish your goals. Some people only worry about those short-term goals. Hey, I want to make X amount of dollars. I need to do this. I need to do that. But in real life, time period is rather important. You're allowed to have short-term, intermediate, long-term, or lifelong goals. One of the biggest things, and this is the hardest things to do in trading, is let others know the time period you expect to reach your goals. You three are the only 3 out of 15, 16, 17 that had this opportunity to do this education. You 3 are the only 3 that stuck it out. Not only that, you stuck it out with your educator, as was so eloquently said by a good friend of mine. So what you're saying is, Kevin, you're the only one that can do it, huh? And for my under $750,000 group, yeah, I'm the only one that can do it. For my over $750,000 group, I look like a dork. But it's helpful to have someone holding you accountable. It's helpful when you set these goals, and particularly for you 3, you've already done what 80% of your group couldn't do. You guys are the top 15% of the Bybee education and what he's given out to all these people. You guys are the cream of the crop. And I can hear Jeff on the other side going, but I haven't made anything yet. And my answer is going to be, well, not yet, but your life isn't over yet. Give it a little bit of time. I would have thought for sure Disney would be at 150 today. And instead, it's trading down towards 98, and it's down today. Down today on a day when the freaking stock just made $82 million on a single movie. Doesn't make a whole lot of sense. But sometimes neither does the market. I'm going to tell you, though, you notice that last little sentence, I promise you that they come. Don't hesitate to find people to use as support. And I think the group that you have right now is a great support group to help you guys get there. To do what it's going to take to make the money you want to. And I think it's a great opportunity for you guys to hold each other accountable. To share, to find out what's happening and why. To find out where Kiva's doing really good on some spread trades, but then to find out how Emily has taken a more conservative route on the collar trades. It's really hard to explain to someone honestly about the stock market. It's really, really hard to look someone in the eyes and to say, I want your business, but I'm not going to lie to you to get it. The stock market is not easy. It never has been. There was a lot of the year I didn't look particularly great. But if I bring up where we're at, give it a second to come up. If I bring up where we're at year to date, You know, a $28,000 return doesn't look too bad on a 7% up market. And that's if the market can hold that 7%. It wouldn't surprise me to see our market roughly flat on the year, to see a rise in interest rates here at the end of the year, and see our market just tumble. $27,953 on $100,000. Most people would kill for that. Most people would kill for a 27.5% return. And for the most part, we had ourselves 100% protected. This is the way to do it. And we didn't look sexy or smart till October, right? Beginning of November. For 10 months, we kind of plodded along, keeping up, losing, keeping up, losing, keeping up, losing, and then boom, all of a sudden one position made our year. This is the way the stock market works. And the neat thing is, I made you no promises, but here's a great example of seeing in real life, hey, here's how you make money in the stock market. And you saw it done right there in front of your eyes. Any questions on anything in general? Let me give you guys a quick second. Any questions you have about anything in general that we've gone over or that you just want an answer to? Jeff says not right now. All right, Emily Keeve, back on the expectations profits, how would you expect to make conservatively on well, it's kind of funny. How much do you expect to conservatively make on 125,000? If we had done what we have done this year, Emily, you know, you could have made 27.5%. I tell you, always start small. Your first goal is 7.5% or 7.75, the S&P average. You then try to double that. Then you want to get up to that 20% range. That's all we were doing this year. This year, you know what? We were down at the beginning of the year because of Disney. We matched the market after the first quarter with Visa. We were down in the summer months from the market average because of Ford. We went into Netflix and we had two horrible earnings on Netflix that we made us money on the downside. Then we had a great earnings on Netflix, and up we are. I don't know if there is an expected return that you can make. And Emily, you're going to laugh at the way I'm going to say this. You will get some dummy that's going to try to sell you a financial plan and say, Emily, we're going to make 8.95%, or we're going to make 10%. And they're going to give you a financial plan and use historical averages. And the one thing I can guarantee you is that you'll never make what they say you're going to make. The market doesn't move linear. It's not linear. So how much do you expect to make on 125,000? Well, this year, at 28%, 30%, you should have expected to make around $36,000. Not a bad return. Next year, if Disney and Ford go back up, you could see another 25% return with having no growth from Netflix or Visa. If Disney and Ford don't go up, you might see a flat year. But the short answer is always start small. Start for that 7.75%. Go to 15, go to 20, and then be more in a protection mode. So, Emily, am I answering your question, or are you saying, Kevin, you just tried to squirt around the answer here for me? I mean, it's a really tough question. It really is, because in all honesty, I still can't predict the future. I wish I could, but unfortunately I can't. Keeve, any questions? If not, let's not plan on meeting next week, but I do want to meet at least one more time to see where we're going to finish off this year. We still have a 12th of our year left in front of us, and a lot can happen one way or the other. We are expecting a rate hike, so I would expect our market to take a bit of a dip when the rates go higher. All right, Keeve has an Apple question. So let's go to Apple really quickly. So our market is overbought. Keeve, taking a quick look at Apple, Apple can't right now get above the 50-day simple moving average, which is a big institutional average. You can see today where it went right up and ahead and it came back down. So I would not do anything today, but if you wanted to start selling puts against your long puts, I've got long puts at 115. You'd probably want to start at that 105 mark. Start selling some puts at 105. You won't get a whole lot of credit for it, but it gives you some protection where that long put can still be used if needed. And your short answer is you really can sell aggressive when you see Apple trade above 112.70. When it gets above 112.70, you know institutions are willing to put big money to work on Apple. So, you know, if you sold some at 105, Apple shouldn't fall past 103. And I would be doing, if you have long puts out in December, you would be doing probably December short puts. All right, guys. Hey, if that's it, I'm going to wish you guys well. Have a wonderful snowy Monday morning. And I will get this emailed out to you so you'll have the notes uh, most likely by tomorrow. Have a great day, and I will talk to you in 2 weeks. Talk to you then. Bye-bye.